Good evening. These are three reversal trading setups that you need to mug up and practice every single day when you come in the markets, especially when you're a person who trades reversals. I'm Devang Mehra. Welcome to the channel. Thank you all for tuning in. Let me give you a quick background. Last evening on Tuesday, today's date is January 19th. Yesterday, January 18th, I did a poll on my Instagram and my Telegram, and I asked people, when you close your day, what are the emotions that come to your mind? 60% of the people, they said that we're satisfied, and when we close the day, whatever is in our destiny, we accept it and we move forward. So we can't trade every single turn in the market. But there were a 40% amount of people that said we feel fear of missing out. We feel that emotion empowering us. And I can tell you one thing, this entire video is based on this concept: how can you get away with that emotion of fear of missing out? So just to give you a quick background, FOMO is an empowering emotion. Every single human being faces regrets of missing an opportunity that gave other people whopping returns. But it surely is an emotion that one must keep in a check, or it is vital to resist that emotion when you put your money into the markets, when you make an investment decision. So today I'll teach you three ideas or three setups that I want you all to follow every single day to avoid this fear of missing out emotion, to avoid paying less money to your brokers because you keep on changing orders and changing sites. So let us get started. Let me give you a quick background of what I'm talking about. You have a good support in the market, let us say whatever this number is, and the market, from the higher side starts to plunge down. You as a price action trader, you go short somewhere over here because some price action pattern told you to go short. Maybe a trend line breakdown, maybe a double top, whatever it was. And the markets are coming down and down and down and down. They come to a level of support that you've identified, and you book out your shorts over here because you feel that it was good profits has been clocked in by you in a short period of time. Let's exit. You go back to sleep, a good 30-40% has been clocked in by you, and you wake up after 1 hour just to find out that the markets from this level of support has gone back up to 17,915 or whatever level the market got sold off from. And then you think to yourself, you said, what the hell just really happened? You knew for a fact that the market came to a support and you could have bought that support, and you see a friend of yours calling you up and he's saying, Devang, I made 100% money today because I bought that support. And you got a whopping, 30-minute rally right back from where the sell-off happened, immediately back into that resistance. And you think to yourself, man, you knew this was going to happen. Then why did you not trade it? And what happens the next time? You get so, I would say, envious. You get so regretful that that when you knew things were supposed to happen, how could you not have traded it? And what happens the next time is when the markets start to fall down and when they come to a support, if you were in short, you cut your shorts over here and then you go long at this support. Why? Because the markets are coming to a support, and then the market goes up and then it crashes down. You had a big loss. Why? Because you were against the market. You do this one more time. The markets come down to a support. You buy the support. It gives you a pullback. Again goes down, gives you a loss. And then you think to yourself, man, that guy was so lucky. That guy was so lucky. Same thing happens with you on the upside. You went long on the bottom side. The market goes higher. Because the market comes to a level of resistance, you go exit your longs and you take a short. Market comes down, goes back up. It's a stop loss. And you start to think to yourself, you said, where am I going wrong? Because I am coming to a support, I should buy. I am coming to a resistance, I should sell. Then where the hell am I going wrong? So this is where I come in. This is the methodology that I want to teach you guys today. First thing, there is a very big distinction. Let me just go to a chart that doesn't move so that you don't get confused by what's happening. First of all, there has to be a very clear distinction that needs to be made between supports and resistance levels. When you come to a support, it doesn't mean buy. Please understand that. When a market is coming to a support, it doesn't mean buy. When the market is coming to a resistance, it doesn't mean sell. You have to, first of all, have an understanding of what is the flow of events till that support is coming. This support could be meaning buy if the market gave you something like this. That could be meaning a buy. But if the market has been doing something like this, then this support in no way means go long. The same applies for a resistance. So having an understanding of what's the structure of the market like, what's the position of the market like till you come to a support, or then when you come to a resistance is important. So there is a very clear distinction that needs to be made in a support zone or in a resistance zone. What I mean by that is, yes, support does mean that when you have gone short in the market, try to book out some shorts over here. But it does not necessarily mean go long. Resistance does mean that if you have gone long from lower levels, book out some quantities here. If not everything, do book out some quantities over here, because the market can try to come down. Maybe not everything, but just partial booking. But it does not always mean go short. The biggest problem that we have been facing in the markets, I have faced all the time, and I know you have faced it all the time, is that we love to trade reversals based on that fear of missing out feeling. If the market is coming down to support, I have to go long because the market will go up. And that leads to hundreds of orders being punched in your brokers. And you know what I'm talking about. So I'm here to teach you 3 methodologies that I want you to mug up and I want you to follow only, and forget everything else that happens in the markets. Okay, let's get started. The first methodology that you need to understand is, if the market, first of all, the first condition that you need to remember is India is a bull market. India is a bull market. It's always been a bull market ever since 2008, 2006, whatever it is. You have seen some falls, some corrections at points of time. It was in 2008, 2011, 13, 15, 2020, for example, but the bull market structure on a bigger chart, the longer term perspective has still always been on. Always remember, when the bull market is in its stretch, the corrections, the falls will always be fast and furious. You have to mug that up. Whenever the market wants to come down in a bull market, it will always come down fast. It will not come down slow and steady, because if the market is coming down slow and steady, in a bull market falling down, it means that something is wrong with that fall, and that fall is a mere farce. It's not going to work out. So if you want to go short, the fall has to come quite fast. That's the first rule. And the bull market rallies, they will be very slow and steady. They will never go up like this in an 80-degree angle, but they will go up slow and steady with pullbacks, with dips and corrections, and they will keep on going higher. So that's the first big distinction that you have to keep it in your mind. The second thing is, the market has been traveling higher and higher and higher, and the market sees a very big red candle. Whatever chart it is, I'm not concerned about that. It applies to every single time frame. Let's say a 15-minute chart, or let's say a 1-hourly chart. The market sees a good bearish candle. Maybe the trend line starts to break, or maybe you see a good double top. Whatever it is, the market starts to come down and starts to fall down aggressively. Why? Because the bull market corrections are quite fast and furious. When the market comes down aggressively, what happens is, till now what was happening is, you were buying these supports, but now you will not be doing that. If you buy supports, you will again mess up your entire psychology, and you will always be that victim of the fear of missing out. Now, when the markets have fallen down, which looks like this, there are only 3 methods that you can use, or that you need to mug up, with which reversals can take place on the charts. The first method is that the markets start to consolidate at a lower level. So for example, you have a support over here, and the market comes down in one go and doesn't consolidate. It's likely that the support will again break after a pullback. But if the market is coming to that support and it starts to consolidate for an extended period of time, that means that the support is stronger. And if then the market starts to break the higher end of this consolidation, then you can plan a reversal trade. This is the first step that you need to keep in mind. The very important message that I have for everyone is, do not think before the chart shows you. Do not try to forecast before the chart shows you. So if the chart is showing you a consolidation, let it first break out on the upside, because it's also possible that that consolidation can lead to a breakdown. So let the chart give you way, let the chart give you direction, and then you should trade in that direction. So the first method, as I said, is when the markets are going down, don't trade just because you're seeing a bullish engulfing, just because you're seeing a hammer, or just because you're seeing a doji. Now, when you want to trade a reversal, get a consolidation for good 2 hours, 3 hours, 4 hours. And when this consolidation starts to break, then you can start to go long in the market. The second method that you can trade is also quite simple. The markets have been going higher and higher, and then they start to fall down aggressively. You need a double bottom on the chart. It's been there for a very, very long period of time. If you want to trade a reversal, if you don't see a consolidation, never ever buy on this first rally. Never buy on this first pullback. Always wait for a double bottom to be formed. What I mean by is this: the market goes higher, it comes down, then again goes back up. This is what a double bottom is. Do some more research on this concept. You'll get an understanding of what I'm saying. When a double bottom is established from a good support, it is showing you essentially that markets are giving you higher lows. And when the higher highs are breaking, that is again a sign of reversal when you can go long in the market. Otherwise, you will always get trapped. So going long on this first rally is something what we've been doing for all our life. You know, that big mistake of FOMO that we're making. I think Nifty, till I keep talking, I think Nifty is something forming a double bottom on a 5-minute chart. So I like to show that to you. So the observation that I have is, it doesn't matter what time frame you trade. I know a lot of people will ask me, Devang, which time frame? See, if I trade a 5-minute double bottom, I will get returns as per 5 minutes. So it's always advisable, if you want to be a positional reversal trade, go for a good, I would say, an hourly double bottom, hourly consolidations, or daily consolidations, daily double bottoms. They have the biggest meaning rather than 5 minutes. So never trade a 5-minute double bottom for a positional trade. I hope you get the idea, because in a 5-minute double bottom, you're going to get a return which is equal to the distance, the vertical distance between them. So for example, a good 50-60 point distance will be achieved if the double bottom breaks. So for example, right now, you can see that the markets are holding the low of 875, 880 levels, and they're trying to go above these levels. So if the market starts to go above this level, then some kind of intraday stability can come. But if the markets don't break the higher level and they start to break down the lower levels, then you can again say there is still no sign of reversal, because still markets have not given you a double top, they have double bottom, and they haven't given you consolidation. Look at the charts. I'll go on a 15-minute chart because I think things will make much more sense from a little bit of a bigger chart. I always suggest bigger charts because intraday 5-minute charts might not always give you the best accuracy, but technical analysis has the universal applicability no matter what time frame that you're on. Look at this chart, for example. You can see the markets give you a big fall. 18,100 was a good level of, this level, for example, 18,130, 120 was a good level of support. But if you just buy the support on no confirmation on none of these three methods, you will go wrong. The market fell down. You can see the market came down, gave you that first rally. Anyone who went long on this rally, again the market went down. It tried to give you a double bottom, it tried to give you a consolidation, but the market never broke 18,050. You can't go long again. The market again broke the lower level, so you can't go long. You have no reversal signal as of now. The market has again fallen down all the way. It's come back up, it's again gone back down. So if the market wants to reverse, it necessarily has to start to trade above 925. If it starts to do that, then double bottom is established. Otherwise, again, the markets will try to go towards lower levels, and they might try to fill the gaps available at 17,820. So I hope you're getting the idea. The third methodology that you can use is basically using the cutoff levels, or when the market starts to go above cutoff levels. So for example, the markets have seen an inside bar forming like this, and the markets have given a very, very big fall, which looks something like that. It's a great breakdown, and the market is trading somewhere over here. Let us say for some reason you get a V-shaped recovery, right? I can't buy the V-shaped recovery here because the sellers right now have a bigger hold on the market. But if the market starts to go up till here, nothing has happened because the selling came from this zone over here. But if the market starts to, in a single shape, V-shaped recovery, it goes above the level from which the selling started. Basically, the cutoff level from which the selling happened has been taken out. So anyone who has gone short from these levels, they have to find a way to cover. They have to find a way to exit their shorts because something has gone wrong with their ideology, with their ideas that the market wanted to come down. So that is why if in one single short recovery, market breaks a cutoff level, a level from which a selling has happened from the charts, then you can say don't buy over here, but just try to buy the dip in the market, because in a way that is also a reversal pattern. Because once their SLs start to get triggered, these people will be using any dips that come into the market for exiting their short exposures, and the markets will then look for reversals. So I hope the ideologies that I'm trying to bring to the table are clear. From today, make it a point that you only trade one of these three reversal patterns and not trade the others. So the biggest challenge I would say in the market is to be patient. And I can tell you for a fact, tens and hundreds of people, they lose the most money in this time period. होता क्या है, market gives you a candle as you go long, फिर गिरता है, you go short, you go long, you go short, you go long, you go short, you get confused, you hit hundreds of orders, you punch hundreds of orders because आपका view ही नहीं form हो रहा. You think every candle is a reversal where it is not. So wait for any of these three criteria to form on the chart and only then trade the reversal. Otherwise, you will get lost in this market. I can give you quickly some examples of how things are, and you will be able to, I think, form a good understanding on the practical application of it. If you have any problems, let me know in the comments. If you enjoyed this video so far, please share it with your friends, alert them, and make sure they mug it up. And please share, like, comment, and follow the channel if you're new. It would mean a lot to me, guys. Thank you so much. So a couple of very interesting methodologies. Let's look back at the 20th of December lows when the market plunged all the way for the 1.5 months. And this was the only time when the markets started to consolidate. I'm on a 15-minute chart. So let me first go on a 1 hourly chart to get a better hang of this, because as I said, bigger is the chart, the better are the consolidations, etc. Look at this chart. Look at what happened over here. The markets plunged down and they started to consolidate over here. They started to give you higher lows over here. That's a signal of reversal. That is something you can use to your advantage to trade a reversal. Not buying every candlestick just because यहाँ पे hammer है, यहाँ पे doji है. Not because of that. यहाँ पे कुछ bullish harami बन गया है. ऐसा कुछ नहीं है. यहाँ पे अगर आप observe करोगे, a really good double bottom is also being witnessed in the chart. So when this starts to break out, that is when you can start trading the opposite direction, not otherwise. So this is one very good example. Secondly, you can see very well how markets have been consolidating. यहाँ पे market stop कर गया and then they started to go high. That's another signal of how the market start to reverse. I can show on an intraday chart of the 15-minute chart, and I think things will make a lot of sense. Just give me 1 second. Yeah, we recently hua tha, so I can show it to you very well. 15-minute chart. Okay, look at this example. This is one example that we have traded in the markets a couple of days back. You can see the market had a good 15-minute range which looked like this, and the market started to give you an inside bar and started to break down below these candles. So that was establishing some bearish pressure in the markets. Now markets में selling कहाँ से आया है? This is the normal selling. Why? Because you are within that 1 hour 15-minute range. But the selling extraordinarily has come from this zone over here. So agar market in a single shot इसके ऊपर निकल जाएगा, so automatically everyone who got short, they got trapped. So in a way they will have to cover. That is why the market started to go higher. That is why the market started to again go up. So this is what I am trying to explain to all of you, how to plan reversals and not get fooled by every single turn in the market. I hope this video was helpful to all of you. So just to conclude, there are 3 methods to trade reversals from today. Don't just come to a support, wait for a candle and buy. That's the most, I would say, pathetic way, which I have lost most money in my past, in my journey, entire journey. The only 3 ways are this: you either let the market come down, come to a support, let them consolidate and then let them reverse, or the market comes down, gives you a double bottom, then you can go reverse, or the market comes down and in a single shot, agar yahan se kahin se selling inside bar pe aaya hua hai, in a single shot, they don't want to come down, they give you some kind of a hammer like this, and in a single shot, they start to go above the level from which the selling happened. That's also another reason for you to look for a reversal in trend. So the most important question that I'll leave you with is, every single day, just decide, do I want to be a buyer on dip, or do I want to be a seller on rise, and accordingly trade the market. So I think these methodologies will help you answer that question. Thank you so much.